Hello and welcome to Money News on Newsmax TV. I'm John Bachman. Joining us right now from New York City is X Bove, author of the new book, Guardians of Prosperity, Why America Needs Big Banks. He also works as the Vice President of Equity Research at Rafferty Capital. And thanks for being with us today, Mr. Bove.
Thank you.
All right, so in this book, you defend the banking industry, especially the bigger banks, that some say are, quote, too big to fail. Why are these institutions worth defending?
Well, I think, we have to think about the fact that it's a very, very big financial market, right? In other words, convertible currencies, the way I calculate them, the dollar, the yen, the euro, is about $56 trillion in the world. And if population growth is what the United Nations claims it will be, it'll be 81 trillion by the year 2050. So in this environment, which is huge in terms of the number of dollars and in the growth rate, we have countries that want to expand their position at the expense of the United States. For example, in North America, if I asked you how many of the 9 biggest banks were Canadian, it might surprise you to know that 5 of them are Canadian, 4 of them are American. In 2005, ICBC, which is the Industrial and Commercial Bank of China, made less money than the 4 biggest banks in the United States. In 2013, they will make more money than the 2 biggest banks put together. So, we are in a position where we're trying to shrink our way out, creating a vacuum in what is a growing market, letting other countries and other banks come in, and the United States will not benefit by that.
And you argue that these regulations, things like Dodd-Frank, are the reason why this vacuum is being created, why banks that come from foreign nations are able to move into the United States and carve out a portion of the industry. Now, what should the government be doing to make sure that the largest banks in the U.S. And other financial institutions are able to compete with these other banks that operate in places like China where they don't have these same types of regulations?
Yeah, I think that one of the most important things is they've got to reduce the capital requirements in the industry. Right now, if you were to divide capital, and I'm going to call capital common equity, by assets, you would find that we have almost the highest level of common equity in the history of the modern banking industry in this country, which we'll say started in 1934. We have too much liquidity required of these banks. We have risk-weighted, evaluations which force American banks out of certain markets into other markets which the government prefers. We are so over-regulating the industry in the United States that we're forcing transactions into the shadow banking market. So what the United States government, in my view, has to do is it has to reduce the capital requirements, reduce the liquidity requirements, eliminate the risk-weighted evaluations. It has to step away from changing the structure of certain portions of the business. In other words, if we go forward with the elimination of Fannie Mae and Freddie Mac, which might be a desirable thing to do or not, we'll also be eliminating the 30-year fixed-rate mortgage and the 20-year fixed-rate mortgage. In other words, we're doing a lot of things which are hampering the ability of the United States banks to compete at the level that, let's say, foreign banks can compete.
And so when we look at things like regulation, some folks will certainly like to hold out things like the recent London whale case and some of the troubles that J.P. Morgan has seen recently with some issues. And folks would say, well, look, these banks are already so big that they cannot regulate themselves. How do you come back and respond to those types of claims?
Well, if we wanted to look at the London whale situation, I think, one way to look at it would be to say, okay, this bank has made, we'll say hypothetically, 50 trades. Let's say 40 of those trades worked out well, 10 of those trades were losers, or even, 25 trades worked well, 25 were losers. The bottom line is, at the end of the day, J.P. Morgan made money. It didn't lose money as a result of its trading activity. So what we've done is we've segregated one trade, or one series of trades, which would be called the London Whale Group, and we've said that that represents what this company does, when in effect it is not what this company has done. This company has made a great deal of money. So you'd say, well, how much money does this bank make? Well, if we took the Fortune 500 and we took a look at where J.P. Morgan stood in the Fortune 500, there are only 4 companies in the United States of any type that make more money than J.P. Morgan. So I then am pressed with the question, how is this showing this company is mismanaged? If this company makes more money the 99.99% of the companies in the United States, why is it considered to be mismanaged? If it makes more money than 495 of the companies in the Fortune 500, why is that believed to be mismanagement? I don't get it.
Yeah, so in other words, one bad apple doesn't spoil the whole bunch, the whole cart at JP Morgan, in other words.
Right. Plus,
All
the
right.
company is making a huge amount of money because it's very well managed.
Now, the banks, obviously, and as you mentioned, JP Morgan being one of those, are doing just fine. But you talked about consumers, the average mom and pop out there, and you talked about some of the other places where these folks are going since some of these new, tougher regulations have been put in place, these shadow lending institutions. I think you're referencing things like payday loans. Why is this dangerous for the little guy?
Well, essentially, if we go back to the mortgages just for a second, and we take a look at the regulations that have been imposed upon the banking industry for making mortgages, in other words, the capital requirements, it's pretty clear that the United States government has made the decision to change 80 years of history in American housing, in that it doesn't believe that poor people should own houses. And that's, the president said himself that we believe that there should be affordable housing for all Americans, but that does not mean that they should have their own single-family home. And in fact, the regulations are preventing banks to some degree in making loans to lower-income households so that they can get their own homes. But let's assume that maybe that's a desirable thing. I don't know. We'll go to another point, which is, because of the price fixing that the Durbin Amendment put on the interchange fees on debit cards, and something called Regulation E, which lowers the, if you will, overdraft fees, what has happened is, we don't have free checking anymore. So everybody in the United States has basically lost free checking, basically because, we've decided to price fix interchange fees and change the arrangement on overdraft fees. If we take a look at credit cards, we've changed the method in which, interest rates are charged on these cards, and we've changed the method in which late fees are charged. What is the result of that? I believe the result is millions of people lost their credit cards, and those people who still have credit cards, many of them, and I'm talking in the hundreds of thousands, have seen their credit lines reduced. So not only are the people in the United States getting fewer services from the banking industry, but they're paying more for them. And I don't see why that makes sense. And I don't see, if we wanted to harm the banks, we should have harmed the banks. And we didn't do that. We harmed the people who use the services that the banks provide.
Yeah, and a lot of folks are just starting to wake up to those issues right now, especially when their credit card bills come in after the holiday season. Now, of course, in terms of regulating the banks themselves, there are some folks out there who are yelling that we do need types of regulation back in place like Glass-Steagall or the Volcker Rule, or we're destined to see another banking crisis like we saw in 2008.
Well, there's no question about the fact that we will see another financial crisis, okay? And that financial crisis will be bigger than the one that we had in 2008. But it won't be because, we're under-regulating the banks. It will be because we've moved transactions out of the regulated sector of the financial industry into the unregulated sector. I mean, think about this. If I were to ask you what the name of the biggest, public mortgage company in the United States is, you couldn't give me a name because it doesn't exist. If I were to ask you to give me the name of 3 credit card companies that are public and are big, you can only come up with one, Discover. MasterCard and Visa, of course, are data processing companies. There are no, consumer finance companies like the old Beneficial Finance or Household Finance or First Plus Financial or the Money Store. We don't have any commercial finance companies other than CIT, and CIT, of course, went bankrupt before it was put back together. So what I'm trying to point out, and by the way, every 21 hours, to give you a gee whiz statistic, we lose a small bank in the United States, and that's been true for 27 years. We've lost 11,200 of these companies. The point I'm trying to make is that monoline financial companies can't go through cycles. They can't raise money in bad times. They have only one source of revenues, and when the cycle goes against them, these companies either sell out if they're smart or they go under. What we do know, on the other hand, is that if we have multi-line financial companies, And those multi-line financial companies are in fact backed by FDIC insurance. They do get money in bad times, and they do have multiple sources of revenues, and they don't go under to the same degree. Of course, one or two go under each cycle, but they don't go under to the same degree as the monoline financial companies. So what are we doing? We're saying we're going to take the most successful companies in the financial system, and we're going to shrink them. And we're going to force them to get out of certain business lines. And we're going to take the most unsuccessful areas of the financial system, and we're going to expand it. So what happens when the next cycle comes along? There's no protection of the banks, number one, because the government has taken that away, and there's definitely no protection for these monoline financial companies that keep going out of business when the cycle goes against you. So what does that mean? It means the next time we have a down cycle in the economy, we're going to have a real financial crisis which can't be stopped.
Well, let's look at this, and we'll move away from the book a little bit and just talk in terms of the overall health of the banks. Would you say that U.S. banks right now are the healthiest they've been since the recent financial crisis, or are they sicker than they've ever been?
They're the healthiest they've been since the Depression. All right. Now, in the Depression, just to clarify that, in the Depression, after the bank holiday of 1933-34, what happened was the American banks stopped lending money. By 1944, only 16% of the assets of American banks were loaned out in the private sector, and they had extremely high levels of capital, only surpassed by what we've seen in the recent years. But the American banking system is not as safe as it was at that point in time. However, the American banking system has more capital as a percentage of assets, as I say, since the Depression. It has more liquidity as a percentage of assets than any time in the last 40 years. Its loan loss activity is below normal. In other words, the loan losses now being, recorded by American banks are below average. So, and the loan to deposit ratio is about 71%, which is the lowest it's been for about 40 years. So the net effect is they're not as safe as they were in 1935, 36, but they are safer than they've been for 75 years.
And what's the main reason why?
Well, certainly, and there's no question about it, it's the fact that the government came in and forced them to build up the excess capital and the excess liquidity that they now have. So the government should be credited with a win on that one, because the government did force these banks into a position where they are as strong as they are at the present time. But one of the costs of doing that is, if you take a look at the excess reserves at the Federal Reserve, there's now $2.4 trillion there. We've never had more than $1 billion plus or minus in excess reserves in at the Federal Reserve. And that $2.4 trillion shouldn't be at the Federal Reserve. It should be loaned out into the economy, assisting economic growth. So it wasn't loaned out. It was put back at the Federal Reserve. It makes the banks a lot safer, makes them sounder, but it also makes the economy weaker.
Yeah, it would be good to get some liquidity in there, and especially that amount of liquidity. It'd be interesting to see what happened. In terms of banking stocks themselves, where do you see those headed in 2014?
I think it's going to be a very good year, simply because if we take a look at the relative valuations of banks today versus where they've been over the last 25 years, even though they've moved up pretty sharply in the last 18 months, they're still not at average levels, number one, and they're nowhere near the high levels. And to give you a specific, banks can sell at 2 to 2.5 times book in good economic periods. If we're going to go into a good economic period in 2014, and I think there's a lot of reasons why that'll happen, then we're likely to see banks earn a lot more money in 2014 because A, there's going to be more loans made, and B, interest rates are likely to rise, so they'll be selling more widgets at higher margins, which should lead to higher earnings, which should lead to higher stock prices.
All right, Bove, bullish on banks in 2014. And aside from regulations, what are the most serious threats facing banks this year?
I think the biggest threat, obviously, is the ability of the economy to recover. Because if I'm wrong and the economy does not recover in 2014, there's no bank in the United States that can withstand a bad economy. They will see bad loans come back pretty strongly, and their earnings will not be anywhere near what we expect them to be this year. But the reason why I think the economy is likely to be good is multifold. I think number one, housing is improving. Number two, autos are doing better. Number three, the higher cost of manufacturing in China is giving us a little edge on the trade balance. Number four, we're definitely not energy self-sufficient, but we're becoming more self-sufficient in energy, which lowers the cost of manufacturing, which gives us another benefit there. Number five, there's an enormous amount of money around. Number six, it costs very little. Number seven, the government deficit is shrinking. So, gosh, there are so many perhaps number eight would be, if we take a look at the wealth characteristics of the American population, the lower 40%, I'm going to unfortunately say there's no hope for their getting back on their feet. But the upper 40% are making a lot more money from their jobs, from their stocks, from the value of their houses, and therefore they're likely to spend more money. So at this moment, virtually everything I look at says that this is going to be a real good year.
All right, well, we'll leave that question of the economic separation for a different discussion. But let's look ahead a little bit. You mentioned all the money that the Federal Reserve has in its reserves right now. When we see Janet Yellen take over for Ben Bernanke, do you see any change in direction at all?
I think there has to be. I think she cannot continue this policy of printing money, to stimulate asset values without getting any major response from the economy. So I think that she's got to, if you will, tinker with her tools, if you will, to come up with some method of getting the money into the economic side of the, if you will, financial system, as opposed to the asset, if you will, side. And I think, that will be done by getting this money out of the Federal Reserve and into the banks and into the lending stream. And the way that'll be done is by seeing interest rates go up and by taking some pressure off on these regulations.
All right, Dick Bove, the new book is called Guardians of Prosperity: Why America Needs Big Banks. Thanks so much for being with us.
Thank you very much.
And thank you for watching Money News on Newsmax TV.